You are looking live at the SPY, which I normally don't start off with, but something interesting happened this week that's only happened 3 times since its inception in 1993, and last week was the fourth. What is that? Well, this exchange traded fund, which mimics the S&P 500, was down 9. It made a lower low, I should say a lower low, 4, 5, 6, 7, 8, and the divine 9, and then it stopped going down. It was made a lower low 9 sessions in a row. It's only done that 3 times. Once in 2003 after the .com 9/11 bear market, and it was down 9 consecutive days and bottomed on January 27th, and it did it again in 2011, bottomed on August 4th, and that time it was down 12 consecutive sessions. And then during the taper tantrum, it bottomed on 12/26. It was down 9 times in a row. What's the significance of that? Well, the 1-year returns for 2003 was 37%, and 2011 was 18%, and then 2018, after the taper tantrum, it was up 34%. So the 1-year return is roughly about 30%. Anyway, I just thought I'd throw that in there. It's good cocktail information. That's what I call cocktail information. So when you go out tonight, you can impress your friends and say, did you know the SPY has only been down 9, made lower lows 9 consecutive times, 9 sessions in a row, 3 times, and this is the 4th. So to me, I don't know. It looks to me like, the sellers have got exhausted and it bottomed out, but we're going to wait and see. Anyway, the Nasdaq is where, I traffic most of my stocks and my growth stocks that I like to trend trade. And this had a nice rally. And then from July 19th here to September 27th, there it is, 14,446 to the 27th, where it hit low of 12,963. It's 11.4% back and fill, correction, consolidation, whatever you want to call it, a pullback, a garden variety pullback, after a move, that we saw from the low or even from the breakout, that's just a normal garden variety pullback. Anyway, I'm going to take a look at the, take a step back and take a look at the monthly chart, because this index is down 2 months in a row of more than 1%. In August, it was down 2.17%, and then in September, 5.81, nearly 6%. So we're going to enter the 4th quarter, or the last 13 trading weeks of the year, and when it does this, down to 1% in consecutive months, August and September, we can expect decent returns. I've got the seasonality charts that I'm going to put on my site, but anyway, it does show that we can expect it's got to get better in a little while, as Eric Clapton's saying, right? And you're going to see a lot of charts, individual stock charts that look like that, with the double bottom base, because the index is a double bottom. So it made a low here, came up, and then made this new low last week, but it stopped going down and it went up 3 days in a row, the last 3 sessions. So yeah, you're going to see a lot of charts that look like that, and it stands to reason, because that's what the index is doing. So anyway, I'm going to move on to individual stocks, and I can't go too much further without getting into the Divine 9, Magnificent 7, Grade 8, whatever you want to call it. And there we go. There's your double bottom base from Apple. Looks a lot like the index. I'm not saying this is going to rebound and go to new highs, but it's probably going to stop going down, right? Looks to me like a flush anyway. After all this selling, I'm not saying it's going to rebound, but I don't know. Hold on. I'm going to go back to the index because I want to show something there's always something for the bulls and the bears. And like I said, a lot of the Magnificent 7 look just like the index. The head and shoulders pattern here that the bears were hanging their hats on, it sure did come to fruition here, as we had a strong right shoulder and then it just gumbied out here. And so congrats to the shorts there. I mean, after 37% bear market. I don't know how much more the bears can really expect. The bulls will point to this, classic cup with handle pattern here. So, and that pullback is to the 30-week line. So that's looking pretty textbook right there. Without bias, trying to be flexible, open-minded, it can go either way. So you got to always allow the index and your stocks to prove themselves. And I'm going to go to Microsoft now. Once again, the double bottom pattern here. It's pretty much across the board here. This is Amazon. I took a swing at this thing and it went against me immediately. So I got out of it with a small loss. But it's had this little base here. And so I thought, 140, it's going to rip here. But, like these things the bases were not long enough. This had like a 5-week base. So now it's in like got to go to a weekly chart because it's a weekly review. Now it's 5-week base. So it's just not enough, so let this thing chill out. It had the 5-week base and it really sold off here the last 2 weeks. And it was down, 8% the prior week. And then last week it fell 1.5%. So maybe it's through going down, has not traded down to that 30-week line, but Amazon showing weakness, but it's got that double bottom pattern look that looks like the index, right? Google has been one of the stronger ones of the mega cap tech stocks, and there's a lot of reasons for the market going down. Of course, the inverted yield curve, the bond rates are up, blah blah blah, but the S&P 500 earnings estimates were lowered, and so that was part of the selling list. Like the expectations are not that great. And to me, that's a positive, not a negative, because it's going to be easier for these big cap companies to jump over that hurdle. I'm not saying they're going to rip to new highs, but I seriously doubt with all their resources and firepower, they're going to, miss earnings estimates. They have the ability to withstand a tired economy or a slowing economy. Anyway, there's Google, and it's just trading right there, just a tick below its 50. So it's holding up better than most in the mega cap tech stock. It's not below the 50, and same with Meta, just right there at the 50. It closed just a tick below it. This thing is just consolidating once again. Just not a long enough base here. Let's take a step back at the weekly. 9 weeks. Okay, that's a little better than Amazon, but still, needs more time. Needs to build the right side here, and needs some buyers to come in. But we got earnings coming up, and they're going to have to deliver the goods on earnings. The other one was Tesla, one of the Magnificent Seven. And this one traded below its 50 and closed just a tick below it, like Meta and Google. Nice consolidation pattern here for Tesla. How many weeks is this? 11 weeks. So a little better than Amazon and a little better than Meta. And the last one I want to look at is NVDA. I know a lot of people post charts of NVIDIA, and this thing is dissected 9 ways to Sunday. Yes, this does look like a bear wedge pattern. I'm just going to let it play out, though. I don't own this thing, but it's below the 50. So bad things happen below the 50. It's 3.2% below the 50. So just beware there. And it can certainly, rip right through the 50. It can go either way. But that is a bearish looking wedge pattern as it tries to wedge higher on the kind of weak volume here. All right. I'm not a big volume guy. I'm going to take a look at some stocks that are doing well. There's a lot of stocks that aren't doing well. Last week we had, only 12% of stocks above their 50 simple moving average, which is the lowest since the COVID lows, I believe. So, it's getting oversold, this market, but it could become more oversold. So I'm just going to go to the leading stocks. I'm not going to bother with, the train wrecks. There's plenty of them out there. And this is AMR, which is the energy coal stocks. These things have been on fire, excuse the pun. Maybe just making new highs, and it just comes back at, these things are hard to buy because, once they break out, they just got these little itty bitty pullbacks, to the 10, so you have to be quick and jump on that thing if you want to own something like that. Some people don't want to own the energy. I like stocks going higher. So same thing here, these little pullbacks to moving averages, giving you a little chance to get in. if you're into such things. NPR is another one. Oh no, HCC, the Warrior. Yeah, the Warrior. This one did set up in a little bit of a base here. It traded below its 50. Had this little cup pattern, had to handle a high handle, kind of shake out here to the 10. And then last week traded higher. This is a weekly review, so I got to look at the weekly chart. And there's your 6 weeks consolidation and then the move higher. These stocks are super strong. I'm going to move on from the coal to, the oil and gas stocks, kind of lumping these ones together. Tidewater, the field and services, oil and gas field services stock up 7, almost 8% last week after a two-week pullback. You can see the pullback here. Let's take a look at the daily. Tidewater, yeah, nice move from 73, pullback almost to its 50, and then just ramped higher. That's a super strong stock. Weatherford is another one that I like. And this one, got to go to the weekly charts, the dailies. Anything can happen in a daily swing. Nice pullback here. It was pretty much flat on the week. It's had a strong run here from this breakout. So you can't expect these things to run forever, but that's a oil and gas equipment stock. And, some of those resources stocks have been doing well. I joke, anything with a resource in it's going higher. This is California Resources. Just pulled back slightly on Friday, 3%, but had a nice move last week, up 1.5%. There's the pullback to the 10-week line. PR Permian Resources, another one, had a 2-week or 3-week pullback on heavy volume down here, and then ramped 6% last week. This one on the daily, you can see it broke out of this consolidation. It has been ramping higher, made that high at 15, then pulled back. And still looks pretty good to me. I'm going to stop right there with all the oil and gas. The Chevron and the Exxon, these are the bigger ones. This one looks to be setting up as it emerges from it's a 200 simple moving average, and I believe this is just like a stage 1 base here, a stage 1B. You can see it's really been consolidating since back here. Hasn't really done much since March of 2022. Last year was at $174, and now it's just kind of consolidating. These are real slow movers, pays a nice dividend. Anyway, I'm going to move on to the something a little more exciting, the software names. MongoDB had a strong week last week. I believe it was ramping at 3% higher, but you could see this sell-off, and all it did was pull back to its 30-week line here. Found support last week, so hopefully the end of the selling for MongoDB, and you can see the classic double bottom pattern, which looks like the index, right? So yeah, we're seeing a lot of these, and hopefully, you want to see them ramp higher, right? There's one that already did break out. This is ESTC. I went out with earnings, I think, but when Cisco bought Splunk, it got another little burst here. And this, I showed you the bear wedge pattern on NVDA, and this is like a little bull wedge pattern here as it pulls back to a moving average in lighter volume, and didn't blast it higher. So that's a really strong stock. I did mention the double bottom breakout from DUOL. That's it, DUOL. And you can see the consolidation pattern here on the double bottom. And this is on the weekly, but on the daily, you can see that it broke. And this is where I missed it. I blew it. It broke above its downtrend line back here around 146. Didn't buy it here, and it's above its 50. There's no reason not to buy that. Anyway, it ran up, then pulled back to its 50, and then last week just ramped higher. I don't know how much it was up last week. Yeah, almost 9%. So Duolingo is another one that looks good. MSTR, MicroStrategy. This one was up nearly 2% last week. And once again, you can see it had this nice sharp pullback, and it's this double bottom pattern that, over and over again. I'm going to stop saying it. The MicroStrategy on the weekly. This is tied to the, the cryptocurrency issues. Anyway, I'm going to move on. I believe, I got one more. Tyler Technologies. This is consolidating in a base. It's expensive stock. I mean, it's not expensive It's expensive because its PE is up. It's not expensive because the price is 386. But anyway, this has kind of a double bottom. It did not quite come down to make the double bottom, but it's above its 50. It closed above its 50 on Friday. So just another one that I'm watching. I'm going to move on from that to retail. And there's just been total train wrecks in retail. I can go on and on. I told you about the train wrecks. Target. Oh, man, look at these. These are just wrecks. Anyway, Deckers is doing okay. I meant to hit Dick's Sporting Goods with all their shrinkage. And, some people told me, hey, Alpha's got shrinkage because they're in Target, but I don't think people are stealing cheap, blush or foundation or whatever the heck they sell. This is really inexpensive stuff. I would think the criminals would be stealing those expensive Louis Vuitton bags or Gucci or Lululemon or whatever. But, criminal is a Greek word for stupid. So maybe they do sell steal this cheap stuff. Anyway, this is another double bottom pattern here. This one needed to sell off. It needed a base. It came within, pretty heavy volume here, sliced the 50, but all it really did is pull back to the 30. There's a couple weeks of selling here, heaviest volume day in a while. And then last week was up, 4.5%. Pretty decent volume on the rebound here off the 30-week line as well. And ELF, I think, as long as they deliver these big numbers here, triple-digit earnings and strong sales growth, I think it's going to be okay and just probably base here. It's been consolidating since this 137, which was back in August 2nd. Okay, so it's been almost 2 months because Monday starts October 2nd. So it is 2 months since it's been doing this little consolidation. If you're a Darvis person, you know that it's just in a little box here. So we'll wait for it to break out of its little box, and hopefully it will. And zoom higher. Anyway, that's the ELF on the shelf. And the other one that in retail that I like is Celsius. Strong sales growth, triple digit. If you're a growth investor, you got to be interested in stocks that have triple digit sales and earnings growth. That are, this thing's been a big winner. Yeah, pull back, but is that the end of the run? Probably not. It didn't break its upper channel line like ELF did, and it's trading right at its 50. The 50 is acting as resistance, whereas ELF is down to its 30-week line. So I want to say it's about 1%, 1.5% below the 50. So Celsius still looking okay to me. And the last one in the retail space is Nike. Stocks bottom when the news is the worst, and maybe the worst is over for Nike. The report wasn't great, but it responded well. They stocks top when fundamentals look their best, they bottom when they look their worst. And maybe, just maybe, all the news about the consumer is dead and the recession's coming, things look horrible for retail. Maybe it'll start to turn around. I don't know. I just take things one day at a time. But Nike did respond well to earnings. It's got this bullish engulfing candle here, up more than 5% last week. So I don't know. We're just going to keep watching the retail space. The other one is the heating and air conditioning. This is a hot and cold business, and CARR was a spinoff. I got to go to the weekly. Maybe we can find out. Yeah, it spun off in right after COVID, but it's been doing well. CARR is just consolidating in a base here, and there's that double bottom pattern, which is familiar to us now. And this is just in a flat base. I kind of like the way that one looks. The other ones in the space, Modine is the kind of the winner for this year. This thing's up like 150% on the year. It broke out and now just pulled back to its 50 for the first time since the breakout. That one looks pretty good. Linux broke out, now pulled back to its 50 once again. Yeah, Linux looks okay, huh? Just we like stocks that go higher. This one's trending higher. You can see the pullback there to its 10-week line. And I'm going to include Train in this. Train's in another industry group, but they make air conditioners. I have one outside my house. Keeps me cool in these hot Arizona summers. And you can see it's been consolidating here in a flat base pattern. Train, it's in the machinery industrial group, but they do make air conditioners, and had a nice inside day on Friday. Decent growth, for an air conditioning business, right? And they make, thermostats, controls, temperature controls. And another one I'm going to sneak in here, we're going to play by our own rules, a steel stock, which is in the industrial, and I'm just going to throw it in here. This one is trend trader's dream, right? The breakout, just trending, minding its moving averages. So a Carpenter, this is one that I owned like back in the early 2000s. Yeah, it was a monster. I got this one from IBD and wrote it, real nice stock. But I haven't come back to it since recently when it started doing this. Yeah, that's a nice move. Anyway, enough with Carpenter. I'm going to move on here. I got a couple more areas to cover, and then I'm going to sign off. This is IONQ, the computer hardware group, is the top performing group by a large margin here in 2023. This thing's up over 300% this year. And if you're, yeah, it looks kind of like a double bottom, but if you're one of those Darvish traders, it's still in this little box here. So we're looking for it to break out of this box above 20 and move higher. The other one is SMCI. This is one that I traded pretty well this year. From 90 to 350 was a nice move. You never buy the bottom or sell the top. I held on too long, had like a 10% position into earnings, and it crashed and burned. But now it's just once again in this little consolidation pattern from 235. It did break above this downtrend line, but it's below its 50. So it's a little risky to be buying these things below their 50. If you want to be, if you're aggressive, you can buy here. But if you're, a little more conservative or want to allow the stock to improve itself, it's got to get above the 50. And that 287 level's interesting level here for a super micro. I want to check and see what the it's 1.5% below the 50, which is it's kind of a downtrending 50, and that's 278.40. So we'll see what it is next week. See if it can trade through there. See if some big buyers can come in. You can see how many sessions in a row this thing's been up. So somebody's buying that thing, and it's not Aunt Sally. DELL is the last one. This thing's partying like it's 1999. They talked about the bottom of the PC market, so we should see some sort of rebound in PCs and those semiconductors that put their chips in PCs like Intel and AMD. But anyway, this one broke out. Massive move, one that's not to be ignored. And it was up, 22% roughly, and now it's trading sideways and making a little shelf pattern. It traded back to its 21 and found support last week. So DELL looks good. And the last group that I'm going to cover is the semiconductor equipment group, just because I like these stocks. And ACLS, strong earnings and sales growth, and just consolidating in this base here. We can see this little, consolidation period, 157. You can see that double bottom pattern again here. Very familiar with the indexes, and just, just consolidating here. ACLS, I like a lot. AEHR, they're reporting earnings this week. And this one, this trade's kind of wild. You got to go to the weekly chart. Maybe it'll calm down a little bit. Yeah, it's pretty choppy. But right here, it's got this cup with handle, 9-week pattern. So going into earnings, it was up more than 7% last week, had an inside week. RS line pretty strong, up down volume 1.2. AEHR looks good going into earnings, but it's gonna do what it wants to do. And I'm going on to. And this one, I just pointed it out because it's consolidating in a base, kind of a thinly traded, semiconductor equipment stock, but it's made nice move here out of this consolidation. And you can see the pullback there to the 10-week line. And the last one is ACMR. And that's it for me today. You can see the base on base pattern moved higher, traded back to its 10-week line. It was up, 15% last week. Not a bad week. Considering the tape, but you can see the breakout, the pullback, and now it's moving higher. Kind of a wild one. Anyway, that's it, except for I lied. In honor of the great Steve Jobs, I gotta say one more thing, and that is this IPO market, which is just a scam right now. The underwriters are just stealing money from retail people. They ran this thing up to what $69 or something the second day. Retail people jumped in all hot and heavy and like fools rush in, and then they pull the rug on you, 69, one day, and the next day it's what, $50, so that's a darn shame. NVDA was willing to pay 40 billion for this one. Right now it's about 55 billion market cap. So if Jensen's not willing to pay more than 40 billion, why should you? Let this thing come in. Ridiculously overvalued stock. Sorry about that. And the other one is Instacart. I mean, just immediate sell-off. I mean, yeah, it's cute. Maple Bear. Who doesn't want to own a Maple Bear stock? Just ridiculous stuff here. You got to stay away from these. They're just out to fleece the retail folks. Anyway, let those things settle down. Let them get some sort of track record. Let the sellers just sell them off, and then we'll come back to them later. Anyway, that's it for me this week. Good luck next week. We start the fourth quarter on Monday, 13 weeks till the end of the year. And it's got to get better in a little while. At mcstockcharts.com, we never give up. Thanks for watching.